Ladies and gentlemen, Greg McCloskey from ForexLive.com. This is a Forex quick look. I'm going to take a look at the sterling versus US dollar as we head toward the close of the trading week and look forward to next week's trading. We've obviously seen the dollar move lower, the sterling versus US dollar move higher after the US jobs report. But there are some key technical levels that we still need to get to and through to increase the bullish bias in this currency pair. Recall this week the Bank of England did cut rates by 25 basis points, so they're ahead of the Fed. But U.S. yields are also moving sharply to the downside, which is kind of doing the Fed's job for them, even though they don't want to do it themselves. So let's talk about the technicals that are in play and take a look at the charts, and so you can prepare for trading next week. Looking at the 4-hour chart of this currency pair, and you can see the big rise to the upside in trading here today. That move to the upside did take the price back above the 200 bar moving average on the 4-hour chart, but we fell short of this swing area up through here. The swing area was defined going back to this period right through here. We had initial swing lows and swing highs, and then we came up to that area here, based against this level and moved higher right through here. Came back down toward this area right through here, found support, and then traded above and below the area until finding some resistance earlier in the week toward midweek. And in today's trading, we moved back up toward the low of that swing area, but as you can see, we found willing sellers. We are back below the 200 bar moving average on the 4-hour chart. That level is going to be a barometer as we go forward in this currency pair into new trading week. If the price can get back above it, it's more bullish, and we start to look toward the swing area. Also look toward the 100 bar moving average is starting to tilt more to the downside here. Those would be the key targets on the top side. Conversely, staying below this 200 bar moving average on the 4-hour chart, we'll have traders looking toward this swing area through here, which goes back in time, and also down here, where I think it's probably a more, perhaps a stronger level. In fact, in the going back in time, you can see how it was a swing high right here. It was a swing high right here. It was a swing high right here. Now we did trade above and below it, of course, through here, but we did find things like support against level through here before moving to the upside. Going forward through here, we did again trade above and below it, but there are instances where the price did base and move to the upside. We found resistance and moved to the downside. We found resistance and moved to the downside. In trading this week, we've moved to the upside. So coming back down toward that level was a nice little bounce off that in trading this week, and that's going to be a key level on the downside. Add to this this area on the downside is the 38.2% retracement. That's of the move up from the April low to the high price that we saw in the month of July. Again, we did get below that 38.2% retracement in trading this week, which should have opened the door to the downside, but couldn't get below that key swing area near the 127.10 level. So be aware of that 38.2% retracement as a level that we do need to get below and stay below if the sellers are going to take control in next week's trading. So, with the price trading above and below the 200 bar moving average, the buyers and sellers are battling it out, maybe consistent with the idea that the Bank of England did cut rates and the Fed is leading that way. So that may neutralize the ups and downs in this currency pair. But I think the technical levels are pretty clear, and we'll see how it all plays out going forward. But right now, the sellers are trying to hold on to a little bit more control in the sterling versus US dollar. My name is Greg McCloskey. Good fortune with your trading. Bye-bye now.